Hey, welcome to the GrowCast show. Today we have a special guest and this is our episode 72. So today we have Marcus Lim, who is a financial advisor. How are you, Marcus?
Hey, I'm feeling good. What about yourself?
I'm perfect. I'm feeling
Awesome.
great today.
All right.
Right, so the very first question I want to ask you is that tell us about your origin story.
Hi, everyone, and my name is Marcus. I'm currently a financial advisor that specializes in investments. My mission is simple: to help my clients grow their wealth beyond what they thought possible, so that they can achieve goals like their dream holiday, upgrading their home, or even retiring early with confidence. So for myself, I grown up in a very modest family. I live a simple life. And to kind of give you an idea, I remember begging my mom for an entire week just to buy me a McDonald's Happy Meal. And that's because of that exclusive week toy that it really felt a luxury back then. And as I grew older, I followed the traditional path as a Singaporean to get a degree, land a stable job, work hard until retirement. But I realized that without proper financial planning, investing from a young age, I should cut a bit.
I can just continue from there.
Okay. But I realized that without financial planning and investing from a young age, I wasn't setting myself up for life that I truly wanted. And that's why I'm passionate about helping others take charge of their financial future and want to empower people to experience the real positive change in their lives just as I have. Yep.
Nice. That's a very inspiring story, Marcus. All right, so the next question is that why is one well-known habit where Singaporeans are happy to spend on convenience but tend to avoid spending in other areas?
Well, as fellow Singaporeans, we enjoy the convenience of having an affordable food and essentials within a stone's throw away. Cooking at home is usually uncommon unless it's for large family gatherings or festive occasions such as Chinese New Year, Eve dinner celebration, or Christmas. So instead, many of us frequently order delivery through services like Grab Food, Grab Deliveries or stuff. And we are willing to pay high delivery and service fees, even if the food arrives lukewarm on our gate. So, however, when it comes to investing, I noticed there is a stark contrast. Many people spend hours researching on news, chasing the latest trends, or seeking advice from friends or colleagues who are financial experts. They often kind of skip professional guidance and try to manage their own investments alone. And then some may actually see early wins, feel overconfident, and then they double down on it, only to realize that they are losing money over time. Others spend on expensive financial courses, drawn to those that what you call get rich quick scheme, only to find basic information that can be found online, and again they get disappointing results. So kind of this creates a cycle of frustration where persistent individual repeats this pattern, often kind of give up entirely and they resign to working, getting themselves paycheck after paycheck to survive. So it's very ironic because many Singaporeans don't hesitate to pay high fees for food delivery, but when it comes to their finances, they are so hesitant to invest in professional management. So this reluctance often leads to losses or abandoned efforts altogether. So I will kind of say in conclusion, prioritizing convenience in some areas are natural, but when it comes to managing wealth, seeking professional help could really make a significant difference in achieving financial security and peace of mind.
All right, so Marcus, who are the most vulnerable age group in terms of insurance and investments in Singapore?
I think let me split it to 5 different groups. First will be the student or those that are serving national service, followed by those that just graduated. The third group will be those that are probably working close to up to 10 years. And the other one could be 20 years or more. And the last group will be those that are close to retirement, meaning to say they are probably nearing their 60s and nearing their 65 where they can start drawing their CPF. Okay, so assuming all group doesn't have any insurance or investment in this context, right? So out of this group, I would say that the most vulnerable would be those that are working 10 years or more. And let me explain why. So those that are working 10 years or more, they're probably dating or married. And when they're married, they also have their own houses.
Correct.
They may also have their own first child and I would say, liabilities. And having said that, when you have so many liabilities, and if touch wood, something really were the main provider were to pass on, that's where it will be a very big drastic change in the entire family lives. So having said that, this group, by having enough insurance, I mean, I'm not here to kind of like elaborate more, but having insurance and also having a substantial amount on their investments, they will be able to kind of like grow through life and not have much issues moving forward.
All right, perfect. So name one attribute that you have adopted that makes you who you are.
One attribute for me is that in order to rise, I believe in challenging the status quo. And that is through taking calculated risks. So I've been born and raised in Singapore. I grew up with the mindset that to follow the traditional path, such as getting a degree, secure a stable job, endure hardship, and hope for better days ahead. However, during my working experience, both as an engineer and a corporate sales in the later part of my life, I realized that progress doesn't come simply just waiting. It comes from taking thoughtful risk or calculated risk, and then by stepping out of my comfort zone. And with that, I was able to actually climb the ladder and move ahead in the competitive race of life. So as we constantly change and adapt, that's one attribute that really makes me who I am right now.
Nice. That is very deep. So why should you invest as early as possible, even if you are young?
I believe there are three reasons why. First is to leverage the power compounding. So I think there is this story that I read from somewhere where chess was invented, and when the person actually present this invention to the king, the king actually offered the inventor any reward. And this person simply said, for every square that's given, you multiply the rice twice. So for every squares, they multiply twice. So one grain of rice to 2, 4, 8, 16. And the funny thing is, the king wasn't able to provide that because it's so much that it will topple the entire kingdom. And just to cut the story short, the unfortunate thing is the inventor got killed by the king.
Oh, that's so sad.
But yeah, so coming back to in terms of power compounding. So if you were to actually compound the investment with time from 1 year all the way to 30 years, you will see a significant increase in the value of money as compared to just investing for over a short period, like a year. Okay. Yep. And next would be why you should invest early is because of the other two, which is first, by having it at a very long time span, you're actually lowering your risks. And why I said lowering the risk is as time go by, you know that market volatility goes up and down. Okay. But overall, looking at the broad index of, S&P 500, it actually trends up over time. And with that, it kind of lowers the risk exposure if you were to put it a very long time. And lastly, I want to kind of reiterate on the capital. So the last point is because you have the time itself, the amount that you invest is actually lower as compared to having a very short time. And the last tip that I kind of want to share is by investing early, you are actually able to learn the mistakes early so that when you are moving in the later stages in life, you will not make the same mistake and then you will actually be able to grow your funds. Yep.
So what do you enjoy about working as a financial advisor?
Let me tell you what I feel disheartened as a financial advisor. I mean, when I hear from my friends or acquaintance asking me whether they can get insurance after they are struck with illnesses, or they basically tell me about something about unethical selling where they mentioned that they are being cheated by other agents based on what they were promised or told, and it felt very unethical. Next will be people rather taking unprofessional advice through their friends, and then they invest in meme coins, NFTs from their friends, and then really taking unnecessary risks. So these are what really disheartened me as a financial advisor. On the flip side, what I truly enjoy is when I'm able to help them grow their investment steadily, even in a down market. And on a personal side, when I hear their positive feedback on how fast they are actually able to receive their claims, also helping them to make sure that they make the right choices for their wealth protection and accumulation. This is something that I truly enjoy as a financial advisor.
All right, so the last question before we go to the part 2 is, what is one limiting belief that most Singaporeans have, and how do they overcome it?
I would say one limiting belief that most Singaporeans have is really putting or setting aside most of their money in the bank, and they deem it as the safest. So probably they are aware or may not be aware of this invisible money monster called inflation. And let me explain further what it is and how it really affects our lives. So let's use chicken rice for some context, right? For myself, when I was in my secondary school, chicken rice probably cost around $2.50 to $3. And that's probably close to a decade ago. And right now, chicken rice will probably cost about $5 or so. And that's almost twice the price. And if you were to actually put this same amount of money inside the bank and then you let it grow over this decade, I don't think you'll see the same kind of growth, right, based on the interest rate that's given. And the reason why is because there's no free lunch in this world. I mean, banks also kind of use the proceeds, the funds that we deposit, to kind of reinvest and do other businesses so that they can earn money. So in order for Singaporeans to overcome this limiting belief of what you call safe haven, right, by putting money in the bank, it's also good to set aside a fixed amount in a ratio to invest the money so that they are able to tap on or leverage on the power of compounding when they really truly need the money. Because ultimately, by putting everything in one basket, and what if it fails, right? Yeah, so that's what I want to share about.
Nice. That's very concise and very thoughtful of Marcus. So that's the end of part 1 of GrowCast Show episode 72. I'll see you guys next for the part 2.
Thank you.
All right, welcome to part 2 of GrowCast Show episode 72. So let's get started, Marcus. All right, the first question is, if you could go back in time and tell yourself what to do, what would the current you tell your past you?
Well, I would say really, going back to if I could go back and tell the past self of mine, I would tell them, really, Marcus, take risks and really try something different. And really, because why I'm coming from this angle is because those that really do things that are different are really those that game change. They are the game changer. So let me quote you some example. Back then, when I was in my secondary school, Nokia phones were really the top. The top technology. Everyone wants a Nokia phone. But the moment iPhone actually came out, it's not the best phone, like the most durable phone, but it was the game changer. So those that really do things different really will be the one that's successful. Even saying that doing things different doesn't mean that it comes easy. In fact, there are those successful people who probably are successful are those that really fail even more than those that are not successful. They're willing to take the risk. So in my industry, I've actually seen people or young advisors, they have joined the industry that, they are joined the industry when they are young, and I've seen how much they have grown, not only personally, but also financially. And really back then before I actually transited to this role, I wouldn't have imagined how much income that they would be having, at their age, because as an employee, I'm just doing what it is from 9 to 5 or probably 8 to 6. It really depends. But the salary cap is really kind of like linear rather than exponential. So going back, I would tell myself really to take risks and try something different. Don't be afraid to fail, but always look forward and embrace changes.
Nice quote. Well, what's the number one piece of advice you would have for soon-to-be or existing parents in Singapore?
Okay, so one piece of advice I'll tell myself as a soon-to-be dad, I would say is really by planning early. And first, by planning early is what we call having an end goal in mind. And having said that, it's always good to plan what is the necessary required things, be it your finances, or the logistical stuff as a parent, and kind of like have understanding in a broad stroke what you really want. So let me kind of expand a little to put some context in terms of finance. The issue I would say for most parents is really when there's any high priority things, we tend to prioritize it. And when situation happens, we react accordingly. However, the truth to it is most of them kind of put finances and insurance at the back burner or at the back seat, and only to regret when really things happen. So by planning early really helps in terms of setting all these things aside so that you can really truly enjoy life or prioritize based on your job and other priority needs. Next, I would say it's on automation. So the thing is, we don't want to every month kind of like transfer the money to our savings and investments, but really kind of automate it so that you can really go on with your life without really thinking about all these backlogs, all this, and which will again affect your mental, because day to day we are so busy with our lives and stuff. So it's always good to automate. And without an end goal in mind, I'd like to share something personal. So for myself, I came from a modest family, and I would say that financial planning is something that my family back then wasn't exposed to. So therefore, I wouldn't been able to have my university degree without financial support through various sources and means. And really, by having this financial support, allow me to really achieve self-sufficiency, afford my own home, and really live a fulfilling life. So it's always good to kind of plan out on a broad stroke, right, what you really want in life, so that when things really happen, at least you don't deviate from the path rather than reacting on the goal. And then by then, let's say you were to reach your retirement age, and then you realize that, hey, I don't have enough, then that would be a very disastrous stage. Yeah.
All right. So which is better, save more or earn more?
Well, that's a very interesting question. So there are actually two common perspectives on this. First, about saving more, okay? I mean, it's really easy, or I would say it's easier to save. But the problem is there's always a limit on how much you can cut back on in terms of after counting your basic needs such as food, transport, and shelter. And on contrary, by earning more or increasing your income, you can actually expand your financial capacity without sacrificing on your necessities. That being said, more often or not, there is always a trade-off. I mean, in order to have a higher income, you probably will be spending more time in your work or taking on additional or more complex responsibility in order for you to attain that higher salary. So I would say, in summary, while saving is really important, focusing on earning more offers greater potential for financial growth and flexibility. Ideally, it's best to actually balance both strategies to give the best results. Yep.
Right. So what are the 3 advantages on investing in 100% pure investment ILP?
Well, I want to debunk the myth that many forums or those that forums out there that flag those ILPs. First, ILPs, there are actually two kinds. First will be those investment-linked policy, I would say. It comes with coverage and insurance. Comes with insurance and investments. So they are like 50-50. And with that, most of the time, the investments, or rather the premiums that the person paid, goes both ways. And then they will actually funnel some of the investments to fund the insurance coverage. And the thing is, when advisors mention about this, they need to give a better or a lot more clarity to the consumers to understand that this is not a pure investment and there's insurance coverage. So this is the first misconception that many people have, and they say that it's a scam. Okay. So right now, your question I would like to debunk, right, is this is purely on investments. That means, having said that, there is no insurance coverage. Okay, so why are these factors that you should consider compared to doing investment on your own? So there are certain perks on doing investing with a pure 100% ILP. So I can name three things. First would be on what we call automated investing, especially during market retracements. So I know it's very technical, but let me explain in terms of more as a common, those common people or folks out there. The thing is, when, let's say you are at a supermarket, and I mean, for example, you use toilet paper. Okay, I mean, just as example, when there is a sale, I mean, you'll be frantically buying, right? But the contrary thing is, when it comes to stock market, when prices are down, people can't wait to cash out. I mean, at a loss, which is kind of funny, right? Because when you invest on something that you truly believe that you'll grow. But when it drops, you should be buying more. But the emotion cycle of people withdrawing at a loss during a market downturn is something that will ultimately impact their finances, especially investing. So what I meant in terms of automated investing during market retracement is it forces the investor or consumer, in a good way, don't get me wrong, that when it goes down, because the pain of withdrawing is a much higher losses, they continue to invest when the market is down. So they technically buy at a cheaper price, a more affordable, when the price is low. And that will actually help them in the long run when the investment eventually climb up. Yeah, so that's one point. Second would be more towards slightly in terms of insurance. So the thing is, when there is a market downturn, what are the different products out there that could provide this thing called capital guarantee upon death? And let me expand on that. The thing is, we don't know, we are not certain when we are going to die. Let's face the truth, the hard truth. And what if it happened that this person, let's say for myself, when something bad happened and the market crashed? I'm not sure whether my spouse or my family will be able to handle the investments, and they probably would liquidate everything and then will go to their banks. So the thing is, if the stock market actually drops, it will feel very painful. And the good thing about this is actually having this ILP plan, investment linked policy, it comes with this thing called capital guarantee upon death. So it actually guarantees you in the event where there's a death occurs, at least the premiums paid is guaranteed. And not only that, because it's under insurance, so it comes with nomination. And let me kind of explain the pain of getting all the finances and everything sorted out takes months. Imagine with this nomination, once you submit all the necessary documents, it probably take way less than 6 months, just to kind of give some context. And lastly, there's this thing called the protection rider. So let me explain what this rider all about. Imagine a person were to invest I mean, they do their own investment. They buy the broad index, and something unfortunate happened where they contracted illnesses. The thing is, when they contract illnesses, let's say stroke or major cancer or whatsoever, right? They are not able to continue working, and by then they'll probably be drawing down on their own savings or investments. It depends whether they have insurance. The beauty of this is having this rider under this IOP plan is that the person need not pay for the premiums for this investment, and the insurer will actually pay for them. So literally, they are being, even though they are down with illnesses, at least their insurance their premiums still get paid until a certain date based on the contract. So that's the true beauty about having investing in 100% ILP. Yep.
Nice. All right. The last two questions will be, do you think planning for your retirement is important even at a young age like your 20s?
Well, I think, so I recalled something from the book called 7 Habits of Highly Effective People. And one habit is really to begin with end in mind. And without a clear vision, it's like a boat drifting in the ocean without a clear destination. So planning for retirement, especially when you're in your 20s, is really knowing the different steps. First is really setting your milestones, such as what you want to achieve in the short term to long term. And it can go on such as like achieving your passive income by a certain age, be it 50, 60, 65. This will allow you to actually create a concrete plan to reach your financial freedom. So without a plan, I mean, there's certainly risk of falling into a cycle of really working endlessly, justifying for the hard work by spending on temporary pleasures such as luxury items, going on vacations without long-term fulfillment. And the funny thing is, based on statistics that I've seen, right, from CNA, it shows that 30% of our seniors in Singapore lack a retirement plan. And these are the individuals who really live through Singapore's strongest GDP growth, the golden age, and yet they face financial insecurity. So in today's competitive and globalized world, adopting early and planning ahead is crucial to achieving financial goals efficiently. And starting retirement planning as early as childhood, I mean, even childhood or youth really provides a significant advantage compared to your 20th. So in summary, really, by having a clear retirement goal, even from a young age, it really empowers you to live with a purpose, adapt to challenges, and achieve financial freedom sooner.
All right, the very final question. So what's the best saving or investment hack you have for busy professionals in Singapore?
Well, I can think of 5 points at this moment. So first is, as a busy individuals, we will be spending most of our time, be it with family or with our careers, really climbing corporate ladder or doing what we can to bring food to the table and so forth and so on. So first is really to automate your savings. So what I meant is automate your savings is really when your salary comes in, it's good to kind of split it. One is for your necessities and the other one in terms of your savings and investments, so that in case of rainy days, you are actually able to tap on the right funds without really compromising your financial future. So that's one thing that really helps. Next is really to diversify into 3 funds. So 3 funds. So let me break it down into these 3 funds. First is to build an emergency fund, which consists about 3 to 6 months of your expenses. So in today's day and age, having a stable job is no longer, or what, civil rights bowl, or a secure job is no longer possible, I would say, unless you're in certain sectors. But this day and age, job security is something hard to find. And with that, it's always good to build emergency fund, which is 3 to 6 months of your monthly expenses as a safety net. And the second point I would say is really to invest in a managed fund. What I meant is setting aside, right, of the portion to invest in the mutual funds. I mean, for example, as I mentioned earlier regarding the ILP, is that you are able not only to invest and grow the funds itself, but also gives you additional safety net in terms of the nominations, the capital guarantee upon death, and also riders in case something unfortunate to happen, such as critical illness, where the premiums will be paid even the person will be contracted with critical illnesses. So that would be one portion that I would advocate on. Lastly, is always to dollar cost average into the broad-based index. What people usually do is to invest a portion of it into S&P 500, the Hang Seng Index, or even our Singapore Straits Times Index. So in summary, having said all three, it's always good to automate, diversify, and strategically allocating your savings, ensuring that you have a balanced financial plan so that you are able to have stability and growth at the same time. Yep.
All right. So that is the end of the episode 72 with GrowCast show together with Marcus Lim, the financial advisor. So I'll see you guys again for the next episode on GrowCast show.
All right.